Welcome to part 3 of this Tesla analysis. What I'm going to do now is do an Elliot Wave appraisal of Tesla, where I'll be looking at Tesla's price action from listing to where it is today, and we can see where we are within the Elliot Wave cycle. Now, for those who don't understand the Elliot Wave principle, it's based on market cycles which were discovered by Ralph Nelson Elliott in the early 30s. He discovered that markets actually move in a rhythm or in a sequence, which he called waves. And he developed this idealized Elliott wave pattern where markets move in 5 waves and correct in 3 waves. So just to give you an idealized view of the Elliott wave cycle, what happens is the market makes a 5-wave advance. Let's just fix this up. Okay, let's just redo this just to make it clearer. So we'll make a 5-wave advance. Without going too much into the rules, the market then pulls back in 3 waves, which we label A, B, C. After this 8-wave move, the market resumes its advance, making another 5-wave advance, followed by another 3-wave pullback. And then the market completes the cycle by making one last 5-wave advance. So in essence, what we have here is 3 5-wave advances and 2 3-wave pullbacks within the advance. And effectively, what we have here is a wave 1, wave 2, wave 3, wave 4, wave 5, but of one larger degree. So this is what we end up with. After a 5-wave advance of whatever degree, the market pulls back in 3 waves. So in this case, it will be A, B, C. Now what we have here is effectively a wave 1, a wave 2, and then the market would resume this whole cycle again to form wave 3, wave 4, and wave 5 of one larger degree. And so this process happens on and on and on and on and on and on until we build bigger and bigger and bigger trends. So if we look at Tesla from listing, I'm just going to play the price action for Tesla, and as it develops, we will add Elliott wave labels. So from listing, and now this is post share split adjusted prices. The market quickly bottomed at $3. So let's just label that $3 low. And then the market started advancing. And just to emphasize, this chart is log scale. So what we see now is the market starting to advance. But what we see here is as the market is advancing, it's not impulsing. We can see there's overlap within these waves. So whenever we see markets overlapping, we know we are either forming leading diagonals or ending diagonals. But since this is the beginning of the cycle, it can only be a leading diagonal. So at this point here, we can see the market has been generally moving sideways. And it would have been very difficult to label the completion of this leading diagonal in real time. But as the market starts to accelerate, then we can reflect back and see that the market did make a leading diagonal for wave 1. So I will label the internal waves of this leading diagonal as wave 1, 2, 3, 4, 5. Can make this blue. And because it's a leading diagonal, we will draw trend lines. I won't go into rules and guidelines in this presentation. I will just be focusing on the patterns. So what we have here is wave 1, 2, 3, 4, 5 for a leading diagonal. So because I know the market advances in 5 waves, I can label this wave 1, wave 2. I'll know we are building a wave 3, which will be followed by wave 4 and wave 5, which will be of one larger degree. So what's evident is the market is starting to accelerate, and whenever we see fast acceleration, we know we are in wave 3 of whatever degree, but we can never know exactly whether the wave 3 will be extended or how many extensions it will have. So if we continue playing this price chart, we can see this move is very aggressive. So we can be confident that this is a wave 3 of whatever degree. Very aggressive move. Then we get a pullback and another rally. Get another pullback and another rally. And then we start to push down. Okay, so at this point, we know with hindsight that this is the peak until we get a much bigger correction. So at this point, we can label this as wave 3. But this wave 3 is also made up of subwaves. And one of the best ways to determine how many extensions we have is to count the waves which comprise this entire move. So with experience and hindsight, I can count this as 1, 2, 3, 4, 5, 6, 7, 8, 9. And whenever we have a 9-wave advance, we know we have an extension. And like I mentioned earlier, irrespective of what degree this wave is, we can see this is a very, very powerful move. So this will be a wave 3 of whatever degree. So if that is to be wave 3, we can label this as wave 1, wave 2, wave 3, wave 4, wave 5. Like that. And then we know that this is 1, 2, 3, 4, 5. So this 5-wave advance is also a wave 3 of another degree. So we can also label this then as wave 1, wave 2. This 1, 2, 3, 4, 5 makes up a higher degree wave 3. Then we have wave 4, and then here we have wave 5 to complete this higher degree wave 3. And we can make that just to change the degrees. So we've got that peak at wave 3, and so far I don't see anything wrong with this labeling. And as we proceed, we are now pulling back in wave 4, and prices start to decline. And they start to push back up a bit, but will crash again. And then we have our crash, then we start to pull up. So here at this juncture, I can label this as wave 4 before we proceed to build wave 5. But this wave 4 has also come down in 3 waves, 1, 2, 3. But the center wave here, with experience and hindsight as well, I can see it has formed what we call a triangle. And I will just zoom in on the triangle and show the internal labels of this triangle. So we've got the ABC correction. And the B wave made a triangle, which I will label A, B, C, D, E. And this triangle then is A, B, C, D, E. Make that dark orange, and it'll be minor. So we have our triangle there. So this is a zigzag with what looks like a leading diagonal, A wave, a triangle, B wave, and a very strong, sharp impulse, C wave. So that's how we look at this correction here. So if we just zoom in again, okay, and if we just tidy it up a bit, now going into wave 5 can take the form of two patterns, either an impulse or an ending diagonal. In an impulse, we will have 1, 2, 3, 4, 5. That's an impulse. And what differentiates an impulse from an ending diagonal is, in an impulse, wave 4 does not terminate in the price territory of wave 1, whereas in a diagonal, we get overlap. So in a diagonal, it will be wave 1, wave 2, wave 3, wave 4, wave 5. And we would then show the trend lines to show that it is a diagonal. I like to make ending diagonals a red color, as they indicate that trouble is looming. So whenever you have an ending diagonal, you know it's a termination pattern, and the market tends to reverse aggressively after an ending diagonal. So going into this wave 5, we can anticipate either an impulse or an ending diagonal. And as we roll forward, see the market started to move up, and as the market develops in real time, you could have labeled this wave 1, wave 2, without knowing whether we're going to get an impulse for wave 3 or further overlap back to wave 1. So at this point in time, in real time, we wouldn't know up until we got more evidence in the form of price action. So as the market continues to rally, now there, at this point, we can see that the market, if this was labeled wave 1, wave 2, wave 3 tentatively, by wave 4 entering the price territory of wave 1, we would not look at this as a 1, 2, 3, 4 in the form of an impulse, but it is taking the shape of an ending diagonal. So within the ending diagonal, we could label this, start labeling it as 1, 2, 3, 4, and 5. In real time, it's very difficult to forecast the termination of wave 5, as it can either overshoot or it can undershoot, meaning it's a truncation when it doesn't make a new high relative to wave 3. So we can also start putting in the trend lines just to show that we are taking the ending diagonal narrative. And then as the market goes up again, it doesn't make a new high above wave 3. And then the market starts to push back up before crashing again. Something that's critical, if we have this as wave 4, the best way to know when the ending diagonal is complete is when the market breaks below the wave 4 low. So at this juncture here, when the market breaks below the wave 4 low, that's where we can be confident that the ending diagonal is complete. So at this point, we can then label this as wave 5, which is a truncated wave 5 as it does not make a new price extreme beyond the termination point of wave 3. And this then completes this wave 5. So at this juncture here, we can label this entire advance as a higher degree wave 1. So if we look at this entire advance from this point where this wave 4 low is broken below, we can label this as a higher degree wave 1. So we've got wave 1, wave 2, wave 3, wave 4, wave 5, that's circled in black, and then this gives us a higher degree wave 1. And now we know we are pulling back for wave 2. And this is the cyclical bear market I alluded to in video 2. And we know it bottomed at 35.40. So right here, We know that the market bottomed here at 35.40. So we can identify that low. It's a significant bottom. And we can label this as wave 2. And also this wave 2, you can see it also went down in 3 waves. A, B, C. A, B, C. Now that we have our wave 1 and wave 2, we know we need to build wave 3, wave 4, and wave 5. So we know somewhere we're going to have wave 3, wave 4, and wave 5. And then as we resume, market rallies a bit, makes a pullback, and then we start to see acceleration in price. And whenever we see massive acceleration, we know that we are in wave 3. And so there we have wave 3 and then the corona crash. So at this point here, we can label this as wave 3. Not wave 3 of this degree, but of one lesser degree. So if I label this internally, I'll have 1, 2, 3, 4, 5. Building up this wave 3. And this is the coronavirus crash. And then post or during the lockdown, we saw that massive price acceleration. So I have to adjust here. Okay, let's just resume up until the most recent price action. So this is where we are as of today. This for me is a clear 5-wave advance. Wave 1, wave 2, wave 3, wave 4, and wave 5. Now that Tesla has been included in the S&P, it's a bit of a concern for me because the market is really almost at the peak of wave 5 of wave 3. So what am I anticipating now? The market can continue to push up and make new highs, but I don't think that the market has got too much more upside left to it before we see a correction for wave 4. Now, after such an extended wave 3, I would look at the market to make at least a 38.2 to 50% Fibonacci retracement. So if I use my Fibonacci tool and I measure the entire rally for wave 3, let's assume that it terminates somewhere there. Let's assume that we go as far as 950 for wave 3. If the market were to pull back 38.2 to 50%, it could take price back towards 490 and below for a 50% pullback. Now, In the Elliot Wave Principle, especially after such a extended third wave, fourth waves do tend to be triangles. So what I'll be looking at here as an alternative to this three-wave pullback is the market making a more complex correction for wave 4. Now this wave 4 triangle would give us something like this. Which I can label A, B, C, D, E. This is primary. Okay, so this would be our triangle for wave 4. And then the market will have to make one last push to the upside to complete wave 5, whether in an impulse or ending diagonal, can never forecast in advance. So this is where I see the market and where I see the market going. We've completed wave 1. We've completed this wave 2. We seem to be almost complete with this wave 3. Now we need to make wave 4 and wave 5. So all in all, the bull market is still intact. Even if the market were to crash here or make a significant pullback, the uptrend is still intact. Whatever correction we see now, it's just a correction within the unfolding 5-wave sequence. So I wouldn't be looking at shorting Tesla. There's too much underlying momentum in the share price. A lot of enthusiasm. The fact that the stock is overvalued based on fundamental valuation models doesn't mean that the stock price is going to suddenly change trajectory and crash and drop to $50 or $20 as many analysts value Tesla at. I easily foresee Tesla hitting 1,000, maybe even more in the next 6 months to a year. But in the short term, I am forecasting this pullback. So, but like I say, I wouldn't be looking at shorting Tesla. I would wait for this pullback for wave 4 and then look to join the upside again as the bull market is still intact. So that is where I say it. And if we now look at this chart holistically, I'll just clean it up a bit. We've got wave 1, we've got wave 2, and here's our wave 3. Just make it a bit neat. Wave 4 there. So there we have it. We have wave 1, which consisted of 5 waves, 1, 2, 3, 4, 5. And now we are building wave 3, which is almost complete, wave 4, wave 5, which will give us a higher degree wave 1. So again, I hope you've learned something, and you can see that the hedge funds have really got the timing of Tesla completely wrong. Shorting the market, trying to back the trend because your valuations tell you that the share is overvalued, can lead you to losing more money than aligning yourself with the trend, which is what the Elliott Wave Principle allows us to do. So I hope you've learned something with this video. Tesla is still in a strong bull market, and any shorts opened against Tesla must be opened with caution. Use your stop losses, have proper risk management, and yeah, I wish everyone a happy and prosperous 2021. I'm certainly looking forward to it, and I'll be trading Tesla almost on a daily basis. I thank you.